All right, Chapter 5, Gross Income and Exclusions. We talked about this a little bit in Chapter 4, but here we get deeper into the details. All right. So, first thing you need to understand is the difference between the term realization and recognition of income. You realize income when, per the book, per the code, when some transaction occurs and you receive an economic benefit. Okay? And I'll go deeper into that here in a minute. You recognize that income. Not only do you realize it, but you recognize that income unless some specific provision in the Internal Revenue Code excludes that income. Okay? And so notice that even when income is specifically excluded, you still have to figure out how much income was realized. You're just not going to recognize it because it either permanently excludes it or excludes it for some period of time down the road. And again, we have this all-inclusive concept of income. It's income from whatever source derived, and to be quite honest with you, wherever derived, even if it's not earned here in the United States. If you are a U.S. citizen, you earn the income overseas, with some exceptions, have to include that income in your gross income. And so it talks about recognizing an income when they receive an economic benefit, 2, they realize the income, and no tax provision allows for them to exclude or defer the income from gross income. Notice here that income is realized in any form. It doesn't have to be money received by the taxpayer. It can be property, so it could be a property for property exchange. It could be an exchange of services for property. Could be an exchange for property for services. Just all kinds of things. Money does. The bottom line is money does not have to exchange hands in order for there to be a realization. Okay, so let's talk about these 3 factors: the economic benefit element, the realization element, and then the recognition. Already kind of talked about recognition, but economic benefit. You have to receive an item of value to have gross income. And that, again, that doesn't have to necessarily be money. It can be services. It can be property. Realization, there has to be some sort of economic transaction that occurs with another party. And the transaction must result in a measurable change in property rights. Makes it a lot easier when that happens because the parties, assuming they're dealing from an arm's length standpoint, are going to determine the value of the items that they're exchanging and transact accordingly. The other part of the advantage of adopting this realization principle is that at least where money is exchanged in a transaction, the taxpayer has what we call the wherewithal to pay the taxes when they receive money. And so we have this thing called the wherewithal to pay principle involved here. You'll see this time and time and again, both in this class and if you take the advanced class as well. But mainly it's for individual taxpayers. When a transaction occurs, the thought is they have the wherewithal to pay the taxes that they recognize. Now again, is this 100% foolproof? No, it's not, because obviously if you are in a barter situation where, let's say, services are being received by one party in exchange for services for the other, well, both parties still have to recognize the market value of the services that they receive. Notice no cash has changed hands, but yet that's a taxable transaction, and they don't have the wherewithal, they may not have the wherewithal to pay the taxes. So again, this is not foolproof. And of course, recognition, if the tax law does not provide any sort of exclusion or deferral, it must be, the realized income must be recognized. Note here under economic benefits, you might ask yourself, well, if I borrow money, is that part of taxable income? And the answer is no, because you're obligated to pay that amount back. Let's talk about the return of capital principle. What happens when you sell property? And property falls under two categories. It could be real property, it could be personal property. Real property is real estate, dirt, buildings, dirt with a building on it, Could be any of those. If it's not that, then it's personal property. And so the argument was, when I sell this, do I have to include the full amount of the sale? Is that the amount realized? And the answer, at least as far as the IRS concerned, was yeah. The full amount of the proceeds was the amount subject to tax. Well, taxpayers argued, well, we should be able to recoup the capital that we invested in this property before any income is realized and possibly recognized. And this went all the way to the Supreme Court, and they don't have the case number or the case name in the book, but regardless, the taxpayers won the day with Supreme Court on that. And so when you sell property that has a basis in it, in other words, you invested a certain amount in this property prior to the sale, you get to recoup the cost of capital before realizing and possibly recognizing any taxable income. And so the formula is, if you look on page Exhibit 5-2 on page 13 of Chapter 5. Sales proceeds less selling expenses, if any, equals the amount realized less the basis in the property sold. That's the amount of capital that you've invested prior to this transaction in that property, equals the gain or loss on the sale. And so you'll hear this phrase, tax basis of the property. Sometimes they'll call it adjusted basis. It means essentially the same thing. And so the return of capital means that the tax basis is excluded when calculating realized income, because it does not represent an economic benefit. It's just returning what you've already invested in this property. And so it's only the gain that you realize, if any, from the sale of the property after excluding the cost of capital. So, and again, if you look at the way this book is designed, or this chapter is designed, it talks about what to recognize as income. And next we talk about when to recognize income. And then last but not least, we talk about who has to recognize income. So, let's talk about accounting methods. It's real simple. For individuals, they file tax returns for calendar year period, and the method of accounting for individual taxpayers usually is the cash basis. If they use a cash basis, when do they recognize income? Well, for individual taxpayers on the cash basis, they recognize income, realize income, and recognize income. In other words, they include it in gross income in the year of receipt. Okay, so real simple. Cash basis, you receive cash. When you receive cash that year, you realize and recognize it in gross income. Now, if you're not an individual, you have other cash methods you can use. You could use a cash method, you could use an accrual method, or you might use what we call a hybrid method. But anyway, that's main thing is individuals use the cash method, so it's real simple to figure out when individuals must realize and recognize income on the receipt of cash. Now, what if, let's say your employer has your year-end bonus ready on December 31, and you just don't get around to picking it up until January 4th of the next year. So, in that case, you're receiving it in the prior tax year. You could essentially defer paying taxes on that for a whole year. So we have this constructive receipt rule to deal with this issue. And so the constructive receipt rule says that a taxpayer must realize and recognize income when it's actually or constructively received. And constructively received is defined as being when the income is credited to the taxpayer's account and there's no restriction. In other words, it's unconditionally available to the taxpayer. And so, in that case, in my example, I didn't mention any restriction. Certainly, taxpayer had the right to pick it up. He just chose not to. Well, what if your employer hands you a bonus check at the end of the year, but says, hey, I'm giving you this check, but we don't have the funds to pay it, but will around January 5th of next year. Well, in that case, there you have a restriction. It's not unconditionally available to the taxpayer. So in that case, that would not be taxed until that next year. All right. Let's talk about who recognizes the income. You would think this would be a no-brainer, but understand that tax law really is kind of a cat and mouse game. The IRS being the cat and the taxpayer being the mouse. What taxpayers are looking for, and usually it's through their tax representatives, tax experts, what they're looking for are tax loopholes, ways to pay legally less taxes. The IRS's job is to, if they discover a loophole that taxpayers are taking advantage of, it's their job to try to close those loopholes. Of course, it may require additional legislation by Congress, but regardless, they want to try to close as many loopholes as possible. And so here, where we have an issue as to which taxpayer recognizes the income, what you have going on here is a taxpayer in a high tax bracket trying to usually shift income to, in most cases, a relative, a family member who is in a lower tax bracket. Because by shifting this income, that income pays overall lower taxes if it is shifted to a lower tax bracket family member. So that's the game that we're dealing with. And so we have this thing called the assignment, the assignment of income doctrine, which holds that a taxpayer who earns income from services must recognize the income. You would think that would be a no-brainer. So I can't tell my employer, hey, employer, instead of paying me for my services, pay my son who is in a 15% bracket rather than pay me in my 36% bracket. If I could do that, I'm saving 21% in taxes, right? Actually, it wouldn't be 21%, but at least on the marginal income it would be. It would be some average. But it definitely would be less, right? All right, so that discusses the assignment of income as it relates to services. What about income on sale of property or income from property, such as rentals, royalties, dividends, interest? What about those? Well, essentially, you've got I guess you would call it the fruit of the tree. And again, that's true with property for services. This is kind of an offshoot of the assignment of income doctrine. The fruit of the tree doctrine simply says that the tree that bears the fruit is taxed on that fruit. Okay, so put another way, if your ownership of the property is what creates the income, then the income is attributable to you. And so you own stocks and the stocks pay a dividend. That dividend is taxable to you. Now, it's at a lower rate, but it's still taxable to you. You own rental property and you receive rental income. Well, because you own the property, you have to recognize the rental income. Okay? So the way to get around this doctrine, the assignment of income doctrine, the fruit of the tree doctrine, is simply, if you want to shift the income, you're going to have to, in the case of property at least, transfer the property to the person to whom you want the income shifted to, okay? So it doesn't work with providing services, obviously, because you're going to provide the services, right? But at least as far as property is concerned, you want your son to, you want to shift the income on rental income to your son. Well, you're going to have to transfer the rental property to your son, because he now becomes the tree, and any fruit that comes from that tree is attributable to him, not you. Don't worry about community property systems, not that important. So, again, taxpayer who earns income from services must recognize the income. Income from property such as dividends and interest is taxable to the person who actually owns the income producing property. To shift income from property to another person, a taxpayer must also transfer the ownership in the property to the other person. Why is that not always wise to do? Well, many of these high income individuals, I mean, they don't get into a high tax bracket for nothing. They do it because they're successful and they make good business decisions. And if they shift property to, let's say, a son who is maybe not so responsible, the higher tax individual loses control over how that property is handled. So it's not always an easy consideration. Talks about the type of income you can have. Income from services is called earned income. It's generated by the efforts of the taxpayer. Income from property is considered unearned income. I'm not sure why. That makes no sense whatsoever in my humble opinion, but they call it an unearned income. It includes the gain or losses from the sale of property, dividends, interest, rents, royalties, and annuities. Not too concerned about annuities, but what I do want to talk about is property dispositions. And again, we kind of talked about this before. So again, taxpayers on the disposition of property are allowed to recover their investment in the property, which is their tax basis, sometimes adjusted basis, you'll see that term, before they realize any gain. And so there's your formula there. Note you get to reduce sales proceeds by the selling expenses, if any, and that is your amount realized, and then you deduct the basis in the property to come up with the gain or loss on the sale. Now, the rate at which taxpayers are taxed on these gains depends on what kind of property it is. What did they use the property for? Was it used for business purposes? Was it used for investment purposes? Or was it used for personal purposes? So we'll talk more about that in the future. Other sources of income. Now, you can have income from services, you can have income from the sale of property, you could have income from a flow-through entity such as a partnership or a limited liability company that elects to be treated as, for tax purposes, as a partnership. Also, an S corporation is treated as a partnership for tax purposes, and that income simply flows through to the taxpayer based upon their proportional ownership interest in the partnership, LLC, or S corp. And so they get the income and deductions, gains and losses during the year that the partnership, LLC, or S corp has, based upon their proportional interest ownership interest. This is an interesting one. If you look back at Form 1040, if you recall, one of the items included in income, and again, I'm back to Chapter 4, page 25 and 26. If you look at page 25, line 11, alimony received. And so you have to include any alimony received as income. Now note, just for future reference, because we'll talk about that in a minute, down in 4 AGI calculation, which is the stuff starting at line 23 down to line 35, notice line 31A, alimony paid. Okay? So we'll talk about both types of alimony. Alimony paid, alimony received. And so here they're talking about income, so we're talking about alimony received. If you receive alimony, it is taxable income to you. And so what is alimony? Well, it's defined as a transfer of cash made under a written separation agreement or divorce decree. The separation or divorce decree does not designate the payment as something other than alimony, such as child support or some sort of property settlement, transfer of a house, etc. And in the case of illegally separated or divorced taxpayers under a separation or divorce decree, the spouses cannot live together at the time the payment's made. That's usually not a problem, but sometimes it may be. And then last but not least, the payments cannot continue after the death of the recipient. That's usually not a problem because in the alimony agreement, it usually says that the payments stop at the death of the recipient. And so notice the types of payment that do not qualify as alimony. I mentioned this before, but I'll mention it again. Property divisions are not alimony and are not taxable. child support payments are not taxable. Notice they're also not deductible by the person either giving the property over, or in the case of child support payments, child support payments are not deductible. So they're not deductible to the ones paying the child support, and it's not included in the income of those receiving child support. If it is truly alimony, and they meet all the requirements that we just discussed, it's taxable to the party receiving the alimony payments, and it's deductible for AGI. See line 31A, to the one paying the alimony. That's a real head scratcher, right? Why should someone paying alimony receive a 4 AGI deduction? Again, I don't have all the answers. Maybe we had a lot of divorced congressmen paying alimony, and so they wanted to make some benefit for themselves. So they decided to make alimony payments deductible for AGI. I don't know. It's the only guess I can come up with, because it just doesn't quite fit in with the other 4 AGI deductions. But your guess is as good as mine as to why it's there. Note also with alimony, and I think we'll discuss this again later, you've got some ability to shift income to maybe a lower taxed spouse. So you have to have so you could basically disguise a property disposition as an alimony payment. So if you got a big front-loaded payment made shortly after the agreement with shorter payments thereafter, the IRS is on to your scheme, and so when these alimony payments are set up, they've got to be fairly even in amount over the time period that the alimony payments are covered. All right, prizes and awards. Now here we're talking about other types of income, right? So we talked about flow-through entities, we talked about alimony. So prizes and awards. Certainly if you go to Vegas and you play the slots and you win X amount, you hit the jackpot, that money is income to you. If you play the lottery, obviously the money you win if you play the lottery is income to you. What if you sign up for a raffle? There's some raffles out there that you could win a house. There's one in Denver like that. You pay X amount for a ticket for the possibility of winning a house. I think it's like $100, $150, $200 a ticket. And you win the house. Well, guess what? That's taxable income to you. Well, gee, I won a house. There's there's what happened to this whole wherewithal to pay thing. Well, tough luck. You're probably going to have to sell the house to pay the taxes. Again, the wherewithal to pay doctrine is not completely circular. It doesn't plug all the holes, okay? Now note, you have some types of exclusions under prizes and awards. If the prize or award is made for scientific, literary, or charitable achievement, and the recipient of the prize or award transfers the prize or award to a qualified charity, that's not included in income. I don't know why we're even talking about that. That's so, I guess a good example here would be, let's say, the Nobel Prize, where they win like $1 million. Well, if they receive the $1 million, the recipients of the award, Nobel Peace Prize, or the Nobel Prize for Science, or whatever, it's taxable to them. But if they transfer it before they receive any benefit to a qualified charity, then not taxable. Social Security benefits, I don't want to get deep into this, but taxpayers who receive Social Security benefits may be taxed up to 85% of their Social Security benefits. And so they have to include up to 85% of their Social Security benefits in taxable income, gross income, and thus will be taxable. Bottom line is, if you're fairly low income, and this depends also on your filing status, but essentially, if you're fairly low income, you'll pay either no tax on your Social Security benefits, but you might, if you're in the mid-levels of income as defined, then you may pay as much as 50%, include 50% of Social Security benefits in gross income, and for high income individuals, as that is defined, you may pay as much, or have to include 85% of Social Security benefits in gross income, and thus taxable. So just notice the numbers. First of all, they have this thing called modified AGI. You don't have to know what modified AGI is, but notice the income levels here. Pretty low. You got to be pretty low income for it to not be taxable, and then if you're at this certain level of between then you might be taxed at 50%, and then if you're over a certain amount, 34,000, then you might be taxed as much as include 85% of your Social Security benefits in gross income. Imputed income. Now, you might receive an economic benefit from a transaction that would be imputed, and usually these are indirect economic benefits. And so usually what is going on here is the transactions between related parties. And so here we don't have two disinterested parties dealing at arm's length. We've got two interested parties not dealing at arm's length. Okay? And so let's just get into what some of these items of imputed income might be. The main one that comes up is bargain purchases. You get to buy certain property for less than its full value. And so there, the imputed income that you have to, that the person receiving the benefit of the bargain purchase has to include in their gross income is the difference between what they bought the property for versus what the property was really worth at the time of the transaction. Another example of imputed income is where a party receives a below market interest loan. So let's say the market calls for a 6% loan and the party receives a loan for 3%. The imputed income is the difference between the two interest rates. Now again, these are usually between related parties, so that's why this occurs. Discharge of indebtedness is another form of income that must be included in gross income. So let's say you have a charge card. You have a MasterCard or Visa, and you just can't pay the bill, and you let it go into default. And a couple of years later, after ignoring the collection calls for a couple of years, you receive from that creditor, MasterCard or Visa, a Form 1099 in the mail. And you're like, why am I receiving this? It's a Form 1099 forgiveness of debt income form. Well, they have put the royal screws to you because they forgave the debt and issued that 1099. Now they've kind of transferred, at least partially, that debt you owe from them to the IRS. Now you owe the IRS, who is the largest and most fierce collector there is. And so you have to include that, $3,000, $5,000, talk about houses. You let a house go into foreclosure and it goes back and then the bank sells the house for much less than what you owe on it, they could, they don't have to, but many do, send out 1099 forgiveness of debt income forms for the difference between what you owed on it versus what they sold it for. And now you've got a debt problem, not with the bank, but now with the IRS. Now, there is an exception to this. And so, if you are insolvent at the time of the discharge of the debt, then the discharge of indebtedness is not taxable to you. So what do you have to do? Well, practically what you have to do is not include the 1099 in gross income. And if you want to be proactive about it, you could simply provide documentation that shows that you were insolvent at the time of the forgiveness of debt. Or you could be reactive and simply not include the 1099 forgiveness of debt income. And then, of course, the IRS will come back and say, hey, you didn't include this in your income. And then at that point, you could show them that you are insolvent. Well, what does it mean to be insolvent? Well, it simply means that you have more debt than you do assets at the time of the discharge of indebtedness or forgiveness of indebtedness. Now note an exception to the exception is if the discharge of indebtedness makes the taxpayer solvent. In other words, you're insolvent prior to the discharge of indebtedness by $500,000, but once the debt is discharged, you're, let's say, solvent to the extent of $200,000, then you have to include in income the amount to which you're insolvent, to the extent you are solvent. So the book says, or the little thing here says, if the discharge of indebtedness makes the taxpayer solvent, the taxpayer recognizes taxable income to the extent of his solvency. So in my example, to the extent of his insolvency is the $200,000. And so that would be the amount that is included in gross income. Now, we have several exclusions of types of income, and these exclusions are meant to subsidize and in some instances encourage particular activities or to mitigate certain inequities. So we talked about this before. Municipal interest on municipal bonds are non-taxable. They are excluded from income. Now notice, if you go back to page 24, 25, on page 25, notice that you have to include on line 8B tax-exempt interest. But yet, even though you have to report it, you don't include it in gross income. Kind of strange, but they want to see that. Why is that? Why do you have to include that? Well, that number goes into the calculation for determining how much of Social Security benefits are taxable. And so again, what's municipal interest? Well, it's bonds issued by a state or local government located in the United States. So it doesn't deal with bonds issued by federal government. It doesn't include bonds issued by corporations. So it's only state, county, local governments, and their subdivisions. We'll talk about this when we get to Chapter 14, I believe it is. Gain on the sale of a personal residence. Taxpayers may exclude up to $250,000, and if you're married filing jointly, up to $500,000 of gain on the sale of their principal residence. They must satisfy these things called the ownership and use tests. If they have a gain that exceeds either the $250,000 gain or $500,000 gain for MFJ, that excess gain is a long-term capital gain and taxed as such. Fringe benefits. You receive coffee at work. That's not taxable to you, the value of the coffee that you use. There's others. There's things such as, you may work at or may have worked at like a retail place where they give you discounts on purchases of stuff. Anyway, if you look at, and so that would not be taxable to you, that discount. So bottom line, we'll look at this again, I believe, in the future, at a future chapter. Exhibit 5-3, though, gives you some of the common types of qualifying fringe benefits, so if you'll look over that. Education-related benefits. And so if you receive a scholarship, to the extent that that scholarship covers tuition, fees, books, supplies, and other equipment required for the student's courses, that amount is non-taxable. Now, this exclusion, well, what happens, let's put it this way, what happens if you are required to work to receive the scholarship? What does that look like? In return for a scholarship, you're required to provide services to the university. Well, that kind of looks like work, doesn't it? You're receiving compensation for the work you do. And so if you are required to perform services in exchange for the scholarship, that's included, the value of that scholarship is included as income in your gross income. Now, there's a limited exception to that for what we call tuition waivers for student employees, and if you were ever to become, let's say, a teaching or research assistant, and you receive free tuition in return, that's an exclusion. You don't have to include the value of the tuition in your gross income. They have certain exclusions that are meant to mitigate double taxation. Gifts and inheritances are, you receive money or you receive anything by gift, a ring, property, other, real property, personal property, money from your rich uncle. That receipt of the gift is non-taxable to you. Well, why is that? Why is it non-taxable to me? Well, probably because it may be taxable to the person who gave the gift under the gift tax provisions of the Internal Revenue Code. So they're trying to avoid double taxation where the donor, the person giving the gift, is taxed, and the person receiving the gift would be taxed under the regular part of the Internal Revenue Code, what we're talking about now. Same goes for inheritances. If you receive an inheritance, that property you receive is non-taxable to you, but it may be taxable to the person giving the property, the decedent. Why? Because they may be taxable under the federal estate tax. Life insurance proceeds, kind of the same idea as an inheritance. The thought here is you shouldn't penalize the recipient because the life insurance amount is going to be includable in the decedent's estate and thus may be taxable under the estate tax laws. Foreign earned income, you can exclude up to $100,800 in 2015 of foreign earned income. Remember, it's not only, you have to include income from whatever source derived, also from wherever derived. So even if you earn income out of the United States, in theory, it's still taxable, even if another country is also taxed it. So to get away from that double taxation effect of one country or two countries possibly taxing the same income, we have actually a couple of different kinds, 3 different kinds of ways you can exclude foreign earned income. So you have the exclusion of $100,800. That's the maximum you can exclude. You also have something called the foreign tax credit, which is under, it's a from AGI itemized deduction. And then you have something called the foreign tax credit. And so essentially what you have to do if you have an individual who is earning income in a different country, these are called expats or expatriates. But this is for some firms a pretty big deal. You have to basically run the numbers under the 3 scenarios and see which is most advantageous to you. is it most advantageous to the client to use the foreign earned income exclusion, or should they use the foreign tax deduction, or should they use the foreign tax credit? Just kind of depends on which is best for the particular taxpayer. Now notice there's some eligibility requirements to that you must meet in order to use the foreign earned income exclusion. So if you'll look at those, not a big deal, but sickness and injury related exclusions. So here you have workers' comp. Workers' comp is a benefit that's actually paid, the premiums are paid by the employer to cover their workers if those workers should get hurt on the job, and if they're hurt on the job and unable to work, and the injuries are sufficient enough to be off work and require medical attention, at least from the standpoint of the wages that are being lost, this workers' compensation is meant to somewhat pay the worker for those lost wages. Is it dollar for dollar? No. I mean, you'll see some fairly high earning individuals. Let's say you're a pipe fitter or something like that. You make, $45,000 a year or $60,000 a year. I don't know what pipe fitters make anymore, but they used to make pretty good money. But let's say they make $60,000 a year, $5,000 a month. Is workers' compensation going to pay them $5,000 a month? No, they're not. They're going to pay them whatever the maximum benefit there is under state law, which may be as little as $500 a month or $1,000 a month or whatever. So it's not a dollar for dollar matching of lost wages. It's just something to get the worker by till they can get back to work, if possible. And so note that even though this is a substitute for income, it's excluded from gross income. Let's say you're hurt in a car wreck. You receive physical injuries and you're off work for a certain amount of time. And you have some emotional distress that's related to the physical injury. Well, usually what's going to happen is at the end of your treatment, at some point there will be a settlement made between the injured party and the insurance company. And so what happens is any medical, lost wages, and emotional suffering related to the physical injury, what some call pain and suffering, are excluded from gross income. The exception is payments that include punitive damages. Also, what's excluded, well, what you must, so bottom line is if part of the settlement is for punitive damages, that part is includable in gross income. Also, if you have some sort of emotional distress that's not related to the personal injury, it's due to something else, and you receive treatment, that must be included in gross income. But if the emotional distress is related to the physical injury, then that is excluded. Healthcare reimbursements are excluded regardless of who pays the premium. So that's a nice benefit. Disability insurance, you get Aflac is a popular disability insurance. You get hurt on the, well, you get hurt anywhere and can't work. This replaces your wages, at least in part. And so the rule is, if an individual purchases the disability insurance directly, any disability benefits are excluded from gross income. If the individual's employer purchases the disability insurance and the individual excludes the benefit from their compensation, so they treat it as a fringe benefit, then the disability benefits are taxable. And in some cases, you might have an election where employer pays part of it and employee pays part of it, let's say a 50-50 type of deal. In that case, only 50% of the disability benefits would be taxable. Okay? And of course, we're going to be talking later on in another chapter about some different deferral provisions. Those are also excluded from gross income.